I don't know. I don't know if it's 2 and 20 or lower.
Yeah.
But even if it's lower, it's just such a huge amount of money that
feels like you could pay some associates with it.
I have a lot of thoughts here.
Welcome to Season 2, Episode 4 of Acquired, the podcast about technology acquisitions and IPOs. I'm Ben Gilbert.
I'm David Rosenthal.
And we are your hosts. Today we are covering an acquisition that has forever changed the world of venture capital, private equity, and emerging technology companies forever. I think I said forever twice there. SoftBank buying Fortress.
It's so forever, it's doubly forever.
It's double forever. And of course, the subsequent creation of the SoftBank Vision Fund. And we will tie up the connection between those two things. But before we dig in too far, David, I just need to say congratulations on the big news this week with the formal announcement of Wave Capital.
Thank you, Ben. Thank you, Ben. It's nice to, as one of our listeners pointed out in the Slack, not have to be totally coy about what I'm doing anymore. So we're excited, and it'll be fun to build Wave over the next couple of years. Who knows? Maybe in a couple of years we'll be bigger than SoftBank. That is not the vision here. See what I did? See what I did? Not the vision.
It's not the vision for your fund.
No.
Awesome to have that news be out, and I'm sure we'll have lots of good opportunities to use that perspective to pepper in good thoughts for future episodes of Acquired.
Indeed.
A little bit of business before we move into the show. If you're new to the show, you can check out our Slack at acquired.fm. I just checked and we're over 1,200 people, so come join us and talk about any big tech news that's going on, suggest episodes for us, and chat with other people who listen to the show.
All right, listeners. Now is a great time to talk about a new partner of ours here on Acquired, Legora, the agentic operating system that is redefining how the world's best legal teams work.
Yep. It's sort of obvious that AI is going to completely change the legal industry. I bet most of you listening have dropped a contract into some sort of AI chatbot out there. Legora took that insight and asked the question, what if you really built something with that power from the ground up for the legal industry?
So the founders did exactly what great founders do, operate with obsessive customer focus. They embedded inside a massive law firm for months. They sat with the lawyers just watching how the work really gets done.
And that's how you get features that customers love, like tabular review, where you drop in a folder of hundreds of contracts and it pulls every key term into a grid a lawyer can actually work with. Legora's bet here is interesting. Since it lets each lawyer handle more complexity, any given person can increase the quality of their work and do higher value work. And this means that the pie can grow even as each individual task takes less time.
And they recently launched Legora Agent, offering greater intelligence and performance. The agent lets lawyers set an objective. Then it can handle the planning and the execution and delivery of the final product. Legal teams get to maintain full control and transparency since they're still involved where judgment is required.
And Legora works where you already work. You can use it within Microsoft Word while redlining or drafting. The early Legora numbers essentially speak for themselves. When they have a head-to-head pilot with their top competitor, they win 70% of the time. Legora now has over 100,000 lawyers on the platform from 1,200 legal teams in 50 countries. And crazily, they went from 1 million to 100 million in ARR in about 18 months.
Truly insane numbers. And that is the real test. Plenty of things demo well, but the question is whether a busy associate actually reaches for it during crunch time, or whether a partner trusts it before going into a conversation with a major client. If your legal team wants to check it out, whether you're a law firm or you're in-house at a company, you can learn more at legora.com/acquired and just tell them that Ben and David sent you.
So David, the SoftBank Vision Fund.
Well, first off, what is SoftBank?
So SoftBank, if there's one big takeaway from the episode, SoftBank, not a bank. It is a conglomerate, a Japanese conglomerate founded in 1981, mostly focused on telecommunications businesses, and actually originally a PC software distributor in Japan.
Indeed. We might just get into that.
We might. So they're going to buy Fortress. We're going to talk all about that. They just started this Vision Fund. Presumably you've heard people talking about the Vision Fund. I'm sure down in Silicon Valley that occasionally comes up.
It's not really a big, no, actually this is like the only topic here. You can go like, you literally cannot walk into a coffee shop in San Francisco or Silicon Valley without hearing somebody talking about the Vision Fund and SoftBank and its iconic founder, Masayoshi Son.
And is SoftBank, is this just relevant like to you as a VC? Is this like, do you hear other folks talking about it? Does it have repercussions outside of just being a venture investor?
Well, so the Vision Fund is currently $93 billion, can go up to $100 billion. It is the largest fund ever raised by anyone in the history of mankind across the entire world, and largest by a factor of like 5. This is literally not just the largest venture fund, but pretty game-changing in the entire investment world.
You may have heard of SoftBank in this recent news of the tender for Uber shares. SoftBank just bought 15% of Uber. They've also made multi-hundred million or billion-dollar plus investments into WeWork, DoorDash, Wag, Slack, and all very, very recently. Like these deals are happening fast and they're huge and they're changing everything.
Which is why we're here on the scene. And it just so happens that a key part of all of it was an acquisition.
If we want to really pat ourselves on the back for timing, which we really can't do, we actually have a content calendar now and we don't know when these things are going to happen. But SoftBank did just announce that they are moving Fortress and the Vision Fund under one roof. They just announced that this past week. And so today on Acquired, we will rewind history and cover the acquisition of Fortress and how that plays into this whole Vision Fund thing.
Should we do it?
Let's do it.
All right. Well, we're doing a little bit of a switch up on history and facts here. We are going to cover Fortress a little bit farther on, but since this is the SoftBank Vision Fund, you really can't talk about any of this without starting with SoftBank. But first, its really iconic founder, who isn't as well known in the US and the West as he should be, although that's changing quickly. But Masayoshi Son, or Masa as he goes by, he's a pretty interesting character. So he was born in 1957 in Japan, not in Tokyo, but on the island Kyushu in the south of Japan. His father was a fisherman, and they were relatively poor. The family, they were Korean immigrants in Japan. So Masa's grandparents were all Korean and immigrated to Japan. That was not a great situation in Japan. Japan has always had a very complicated relationship with both Korea and China. When Masa was growing up, the Japanese government actually mandated that all Korean families in Japan had to change their surnames to be Japanese. So they had to essentially like reject their identity. And this happened when Masa was young. So his family changed their surname from San to Enmoto.
Real quick, David, is this like a thing that you knew about culturally before doing the research, or is this a part of your research process?
No, I did not know this beforehand, but Masa talks a lot about this. So this was like really formative to him. There's a great, we'll link to it in the show notes. He goes on Charlie Rose a couple of years ago. Charlie Rose is a little bit of a controversial character himself now with some of the sexual misconduct allegations. But this interview with Masa is really great. He talks about his childhood and how much it shaped him. So through all of this, though, even though growing up, son of a fisherman in rural Japan and the island, his parents really encouraged him and told him that he was going to be great. And he was really precocious. He was going to do great things. When he was a teenager, there was a guy in Japan who was the president of McDonald's Japan, and he had written a book, a business book, and Masa got a hold of it. He read it, and he was super inspired. He decided he had to meet this guy, and so he started calling his office, got a hold of his secretary, and kept calling, like time and time again, saying, I need to come, I need to meet with him. And he said, the secretary said, no, you're not going to meet with him. Finally, Masa flies to Tokyo, just shows up in the office to meet with this guy and says, I'm not going home until I get to meet with him. He does. He's 16 years old at the time. Finally, the guy says, all right, I'll let you in. I'll give you 15 minutes.
It's a war of attrition.
Literally war of attrition. And this guy tells him two things. Masa asked for his advice. What would you tell me as a young 16-year-old here in Japan? He gives him two pieces of advice. He says, one, learn English. And 2, study computers and computer science because that's the future.
Which is advice that you get today, not advice that you would have gotten, in the 60s and 70s?
This would have been the mid-70s.
Wow.
Pretty crazy. This guy was pretty prescient. Massa, as you can imagine, knowing this little bit about him so far, he not only takes the advice to heart, within weeks, he moves to the U.S. His family has no ties to the U.S. and moves to the Bay Area, ends up finishing high school in the Bay Area, goes to university here. He goes to, he does 2 years at a college called Holy Names University, and then he transfers to UC Berkeley, where he majors in economics and computer science. So he's just going, and it's all of this is because he wants to follow in this guy's footsteps. He wants to be a businessman. He wants to start companies. So while he's at Berkeley, after he transfers there, he does 2 things. One, he convinces one of his professors to start a company with him. It was a physics professor, and they make an electronic translator, a language translator, and then they sell it within a year to the Japanese conglomerate Sharp for $1.7 million. Remember, this is back in the late 70s. So,
and a student. What an awesome thing to do as a student.
Yeah. I mean, a couple of years ago, he was, in a fishing village in Japan. And then the other thing he does during this time, partially with the proceeds from that sale, he starts importing Space Invaders arcade machines from Japan to the Bay Area and to the Berkeley campus. And supposedly, according to Massa, he makes about $1.5 million from...
Presumably more money than his share of the sale.
Yeah, totally. Totally. It's totally reminded me of Tony Hsieh and Alfred Lin and the Zappa story shop. And selling pizza. Pretty crazy. So by the time Massa graduates in 1980 from Berkeley, he's already a multimillionaire. And so he decides he's going to go back to Japan. In the interim, he starts another company called Unison that gets acquired quickly by Kyocera, which I believe is a Korean company. Unclear how much money that one was for. Masa doesn't talk about that one. But he decides he's going to come back to Japan. He's made, a little bit of a mark. He decides two things. One, he's going to change his last name back to San. He's done with the Japanese name that his family had adopted. He talks about this. He feels like he's living a, false life. He wants to be himself, be his true identity, and be known as, for what he is. And 2, he decides, I'm going to start another company, but this one is going to have an enormous impact. So he moves back home. He literally lives at home, lounges around for about 6 months or so, and decides to start a company and calls it SoftBank. Why SoftBank? His business plan, what he wants to do is he wants to be a distributor of software in Japan. And this is back in the day, software, there are no CD drives. These come in packaged boxes that you buy in stores.
In a zero distribution cost world, we tend to devalue distributors. In our heads, that doesn't strike you as a huge business. That was an essential part of the value chain that was, there are a lot of economics in there in a pre-internet world.
Yep. Without distributors, without retail, and without B2B distribution of software on, floppy disks, probably not even the 3.5-inch floppy disk, probably the big, truly floppy disks at this point, you can't get software onto your PCs. So he starts that, and he also realizes that part of succeeding in distribution is you also have to be in the publishing game, and not just publishing software, but actually publishing content so that people discover software and want to buy it. So he starts publishing PC magazines, first in Japan, realizes that that's actually a really interesting business itself, and that goes pretty well. And he decides he wants to start to expand. And he wants to get back into the US where he was educated and knows how much innovation is happening in software there at the time. So we're now into the kind of mid 90s. He does 2 things. First, he buys Ziff Davis, which was the publisher of PC Week and a whole bunch of other stuff. And I totally remember reading these magazines back in the day. So SoftBank acquires Ziff Davis, and then he also acquires
Comdex?
Comdex, yeah, an organization called Comdex, which was that was the computer show. Yeah, it was computer show.
If you were into computers and you were a distributor or a creator, if you're actually, have you seen *Halt and Catch Fire*, David? the TV show?
No, I've heard it's so good.
It's awesome. One of the big moments in the show is the first sort of demo at Comdex. I think this predates both you and I, but if you were into computers in those days, that was where you went to check out all the new stuff.
Totally. Yeah, like the South by Southwest or, what have you of its day.
CES, E3, yeah.
CES, yeah. All of it like rolled into one. It was all there was in the tech industry because it was all PCs. So he's now got this kind of empire going. And this is the mid-90s. He's starting to see the internet is coming too.
And let's shape this empire. It's a little empire of PC distribution and media and events about PCs.
Yes, in Japan and now in the US. He starts to see that the internet is coming and there's going to be a big opportunity to invest in lots of companies that are going to create new businesses on the internet. So what does he do? He starts a VC firm, a US venture capital firm under the SoftBank name, and he brings on a few partners to be the partners and investors locally in the US at this VC firm. Do you know, Ben, who one of those partners was? Brad Feld of Foundry Group. And listeners, Brad is of course at Foundry Group, and Foundry's an investor in PSL and Wave as well. And so Mobius, which was the firm that he started before Foundry Group, and where most of the Foundry Group partners had worked together at Mobius before, that was basically a spin out from SoftBank.
Got it.
And a number of them had first started working together at SoftBank.
Got it.
And I believe Brad can correct us here, but I believe Brad's first company that he started in Boston out of MIT was a software publishing and distribution company. And I believe SoftBank acquired it. And then that's how he got in into VC.
We'll have to have Brad on the show and give us some of this history. That's awesome.
Yeah, totally. So fun aside. So they start this US VC firm. And these are the go-go years of, the mid to late 90s internet. Both the US VC firm and SoftBank itself, corporate, invests in tons of companies. They end up taking stakes in about 800 companies across the world. And one of those companies is Yahoo. So Masa, when he's in the US at one point in time, he ends up meeting Jerry Yang right as they're getting started. And SoftBank invests a small amount in Yahoo. I don't know if it was alongside Sequoia or before or after, but they become a major shareholder in Yahoo. They end up investing about $350 million in Yahoo. And at the time of the IPO, SoftBank is the largest shareholder in the company.
And they started Yahoo Japan, right?
And together, Masa goes and proposes to Jerry, Yahoo, what you're doing in the US, like you need to do that around the world too. Why don't we start Yahoo Japan together? So they do that as a joint venture. It becomes hugely valuable, ends up IPOing in Japan itself, and is a huge win for SoftBank. So you can start to see like some of what they're doing with the Vision Fund. It's kind of like what's old is new again. They've been doing this all along. They approach Amazon. They want to do the same thing with Amazon, apparently. And Bezos rejects them because Masa and SoftBank want too much of the JV, of the combined company in Japan.
It strikes me that Bezos says, "What do you mean that's my opportunity?"
Yeah, exactly. Exactly. So this is crazy. And I knew a little bit of this history before I started diving in and doing the research, but this actually is shocking. So this is all going, so well during the internet bubble. For a brief moment, Masa actually becomes the wealthiest person in the world. He passes Bill Gates. SoftBank's market cap goes up to almost $200 billion, and they've got the stakes in all these companies.
Bubbles do crazy things to non-liquid stock.
Indeed. And so apparently he's like vying with Bill Gates through all this to be the world's wealthiest person. Bill comes over and visits him in Tokyo, and Masa had built, he tells this story on Charlie Rose and elsewhere. He had built in his house, in his mansion in Tokyo, a golf simulator in the basement that was like, so not just like like video golf, but like had simulated sea breezes and like ocean scents and like all this stuff and simulated light. And apparently Bill Gates is like blown away.
I mean, this is the point in Bill Gates' life where it was like famous that he had the pictures that change on his walls.
Yep.
Like that's right up his alley.
Yep. Unfortunately, though, for Masa, shortly after he passed Bill, the bubble burst. And then Masa gets another infamous distinction. I believe this is still the case. As a single person, lost the most amount of money that anyone has ever lost in history. So his personal wealth within a matter of weeks during the bursting of the internet bubble fell by 70 billion.
Oh my God.
In 2001.
That's like the GDP of a small country.
Yeah, totally. It's like, 7/10 of the Vision Fund. But he learns a couple things from that. And, ever the resilient individual, he's kind of more determined than ever to come back. But what he learns is that, and what he decides after that is that cash flow and profits are very important in businesses. I mean, notoriously, part of the problem with the internet bubble was like, there wasn't even, certainly not cash flow, not even revenue at a lot of these companies. And so Masa kind of learns the lesson. He's not going to do that. He decides to pivot SoftBank at this point away from just being a software and company and tech investor into more infrastructure. He gets really interested in infrastructure because he sees the sort of attractive cash flow dynamics of it. And specifically what he does is he gets into broadband in Japan. So this is when broadband is like, becoming a thing and people aren't using dial-up anymore. And Japan was particularly advanced.
And we should say one other thing that happened during this time in 2000, still kept doing some early stage investing. And one of those investments was a $20 million.
We're coming to it. We're coming to it. Cliffhanger. He doesn't stop the investing. But so he gets into broadband. He buys Japan Telecom and then starts investing in broadband. Sees that, I promise I'm going to come back to the investing in a minute. But this is actually, I think, an even better story. He starts seeing that mobile is going to be the future. And this is a thing about Masa. Like, he's very bold, but he's always thinking like a couple years in advance. So like mid 2000s, Japan, mobile telephones are much more advanced than anywhere else in the world, but it's still not like what we think of as mobile today. It's kind of like halfway there. He decides that mobile's the future of the internet. He wants to get in on it. And what's the best way to do it? He thinks he needs, he's not in mobile at all. He's only in wired broadband at this point. He thinks he needs like a game-changing, really, device to do this. So he flies to the US and he meets with Steve Jobs. This is in like 2005, 2006.
What?
Yeah. So Masa, he's thinking about how he can enter the mobile, telephone world. He decides that he needs a game-changing device. He decides the only person in the world who could develop such a device would be Steve Jobs and Apple. So he comes over, he meets with Steve. This is like 05, 06. Apparently he brings a drawing that Masa himself had made, a drawing of an iPod with a phone in it. It's like apparently like the Tony Fadell version of the iPhone.
No way. He did he made the P1.
He made the P1. He sits down with Steve. He meets with him and he's like, I want to get into mobile. I need a great device. You should make it. I have a drawing for you.
And meanwhile, Apple's in the midst of this head-to-head internal competition, 12 months away from launching the iPhone.
Totally. And Steve apparently laughs and he's like, I don't need your drawing. Like, you think we're not working on this? And Masa's like, fine, I don't care. Like, if you make this, I want to be the first. And Steve's like, this is hilarious. Nobody knows we're working on this, but we are. But because you came to see me and you said you had such chutzpah to, show me a drawing, I'll work with you on it. So, let me know what you need. But, we need a mobile carrier. And Masa's like, I got it. Give me like a year. So he goes back to Japan and he orchestrates a deal to buy Vodafone Japan, which is was one of the largest mobile carriers in Japan, like AT&T or Verizon or Sprint, but he doesn't have the money to do it. So he goes and he raises like $20 billion in debt financing from the capital markets. And in particular, he raises, I believe most of it from Deutsche Bank, from a guy named Rajiv Misra at Deutsche Bank, who's going to come back into the story in a little bit. He ends up buying Vodafone, knowing in his back pocket that when the iPhone does come out, he's got this handshake agreement from Steve to be the exclusive provider in Japan. That's in 2006. iPhone obviously gets announced in 2007, goes on sale in the US. And then in 2008, the newly renamed SoftBank Mobile, which was Vodafone Japan, becomes the exclusive carrier of the iPhone in Japan. And this is huge. They triple their market share. Japan falls in love with the iPhone.
3D chess, David. 3D chess.
Totally. All because of that drawing. So this is arguably, at this point, the greatest thing that's, happened to SoftBank. Huge comeback from having had the infamy of losing more money than anyone else in the world. And then actually later in 2013, he tries to get into U.S. mobile carriers. They buy Sprint. So SoftBank owns Sprint here in the U.S.
And wholly, right? They're a 100% owned subsidiary.
I think at first they bought 73% or something like that. I don't know if they now own 100% of it, but they certainly own a vast majority of the stake. But there's this other little thing that happens over the interviewing years that Ben, you were referring to. And that was that all the way back in, it actually was in 2000, so it was before the tech bubble burst. Masa made one other of the 800 investments that he made. He put $20 million into a company in China called Alibaba in the year 2000.
14 years before they IPO'd.
14 years before the IPO. So fast forward to 2014, Alibaba goes public in, I believe, the largest IPO ever. Definitely one on our list that we're going to have to cover. And when that happens, that stake that SoftBank owns in Alibaba is now worth $60 billion in liquid, publicly tradable securities on the open market. And that really is a combination of all of these things. But I think it's really that leads to the Vision Fund. All of a sudden, SoftBank has $60 billion that they've done in tech investing in liquid securities. And that happens in 2014.
Is my math right there that's a 3,000x return on $20 million?
It's uncalculable. And people talk about this as this may well be, lots of people reference this as the best investment of all time. When we did the Next acquisition, the Apple acquisition of Next, we called it the best acquisition of all time that created $1 trillion in market cap. I think that $20 million investment might be the single best investment anyone's ever made.
Do you know if that's how the Yahoo Alibaba relationship got started? Do you know if there's a tie-in here?
There definitely is. So I didn't research the exact timeline. So I don't know if it was Jerry Yang who first met Jack Ma or if it was Masa who first met Jack Ma and invested. But both of them, both Jerry Yang and Yahoo and Masa and SoftBank invested in Alibaba.
And that was famously a huge part of Yahoo's market cap when Alibaba went public was the Alibaba shares.
Yep. And a couple years before Yahoo ended up getting sold off, they sold half of their stake in Alibaba before Alibaba went public at a much lower valuation than when they did go public.
You got to have Masa's conviction to hold, man.
Totally. I mean, this guy is like if it wasn't clear already, he's a pretty amazing character.
He's not the Oracle of Omaha, but the Oracle of Japan.
Yeah, he's like the Jeff Bezos and Warren Buffett of Japan, rolled into one.
Feels like a guy that should deploy $100 billion. I don't know.
Well, if anybody can do it. So today, Masa is the richest person in Japan. And so he has accomplished his, that wasn't explicitly his goal, but when he started SoftBank, he wanted to make an impact. And he is the 39th richest person in the world. As of January, his personal net worth was estimated at about $22 billion. So still not the 70 that it once was, but still pretty amazing. After that IPO of Alibaba in 2014, they now have all of this capital. It's taken a long time, but they've been very successful at being investors.
One thing that is worth noting is they don't always work. They bought Sprint, but Sprint hasn't hugely grown in value. They're good investors. They also had a huge return on buying some Supercell shares and selling to Tencent. But Sprint isn't anything to write home about. It doesn't give you tens of billions of dollars on which to go and raise the largest fund in history.
Nope. But if you have 60 billion of your own, that gets you a long way. So a couple things. In 2015, they bring on a guy named Nikesh Arora. And Nikesh had been an early Google employee, and he was the chief business officer at Google. So he was in charge of building all of Google's ad business over the years, and he was essentially head of monetization. They hire him away at SoftBank. He becomes the president and COO. And he's very explicitly like next in line to kind of take over for Masa when Masa retires. Masa's in his late 50s, early 60s at this point. Nikesh, and then they get, they have all this capital now from the Alibaba IPO. Nikesh is originally from India before he came to the US. He starts investing in India growth companies. So like 2014, 2015, there was a big, in retrospect, really kind of bubble of tech startups in India. Companies like Ola and Snapdeal and Flipkart.
Wait, did you just say Snapdeal and Flipkart, David?
SoftBank invested in Snapdeal, but not Flipkart.
I think they actually did. So I think.
Oh, did they?
I think kind of a crazy thing is one thing they're willing to do is cut and run, or at least invest in a competitor. So Snapdeal wasn't going the way that they were hoping it would go. Later on in the Vision Fund in April of 2017, they put $4 billion into Flipkart.
Oh, wow. Huh. But that was via the Vision Fund. Okay, so that hadn't happened just yet.
Right.
Nikesh had kind of led investing in these companies in India.
So yeah, I should take that back. Maybe that's not fair. Maybe a better assessment is, that was a different entity, a different vehicle.
Yeah, interesting. Although it is part of the Vision Fund's reputation now. And Nikesh, when they hired him, they paid him, his contract was, he got paid $200 million over 2 years. He was the highest paid executive in the entire world. When Masa does something, he goes big.
David, it's not that much money because it's tranched out over multiple years.
Yeah, 2. But as you were alluding to, some of these India investments don't go so well, particularly Snapdeal. And the relationship kind of sours between Nikesh and Masa, supposedly for a bunch of reasons. And Nikesh actually leaves in 2016. And so now there's kind of this hole of Masa's, still has this huge vision for SoftBank and investing, but the guy who was going to run it is no longer there. Now, flashback to right around the same time as the Alibaba IPO, Rajiv Misra, who I had mentioned earlier, had been at Deutsche Bank and had helped orchestrate the debt financing for the Vodafone Japan acquisition. Masa had also lured him away and hired him into SoftBank as head of strategic finance.
Rajiv is from India, but London-based. Is that correct?
Yep. Based in London. Yep. Also from India. And then Rajiv worked on what I believe was and still is SoftBank's largest acquisition, which was the UK company Arm Holdings, the designer of mobile phone chipsets, which ultimately got done in 2016 for $32 billion. So that was what Rajiv worked on for his first couple of years. And so kind of simultaneously as Nikesh is leaving the company and Rajiv has just had this big success.
And it's worth pausing for a moment there. It's interesting to look at pre-Vision Fund SoftBank, what they're doing in this era. They're really building out different pieces of the mobile value chain. So they've got the commerce layer with Alibaba. They've got the telecommunications layer with Sprint and with SoftBank Japan. They're buying the technology that is the design for the chipsets of every mobile phone today, all the way down at the hardware layer. It's a very clear play on we want to benefit from every piece of the value chain on what we see as the future, and it is mobile.
Yep. Well, it really gets back to that vision, which will, quote unquote, that Masa has after the bursting of the tech bubble of getting into infrastructure, getting into cash flow businesses. And, what are sort of like the Amazon tax? Like, what are the elements of this massive market for mobile? What are the elements of the value chain that are, just as mobile grows, are going to be taking a tax, on the industry? And it's chip design, it's the carriers, it's commerce and Alibaba. It's all of these things. So they acquire Arm. And then immediately after that, another interesting meeting happens. Masa and Rajiv are starting to think about, Nikesh is out. They're starting to think about like, how can we really systematize this investing that we're doing and really build something large? And Massa ends up having a meeting in 2016 with the deputy crown prince of Saudi Arabia, who's in charge of running Saudi Arabia's sovereign wealth fund.
That's an amazing title.
Total. The deputy crown prince.
I want business cards that say that.
Yeah, totally. It's like the famous Mark Zuckerberg CEO business cards.
Yeah. Which I don't think we can say on the show and keep our clean rating.
No, I don't think we can, but you should go watch The Social Network if you haven't already. So Massa gets this meeting in Tokyo with the deputy crown prince. Apparently, it's a 45-minute meeting. And by the end of the 45 minutes, Massa has convinced the crown prince to invest $45 billion.
Yeah,
Massa
that's how mine always go. Yep.
$1 billion
similar.
per minute. Yep, exactly. I mean, that's really how it went at Wave. Not quite. So by the end of this meeting, they have a commitment from the Public Investment Fund of Saudi Arabia to put $45 billion into a new global technology investment fund that SoftBank is going to start and that Rajiv is going to run. And that's the beginning of the Vision Fund. So SoftBank itself commits $25 billion on top of the 45 from Saudi Arabia. So that gets us to 70 billion.
That's a heck of a general partner commit right there.
Yeah, totally. Yeah, we did the same at Wave. No, not even close. And then they announced at the end of 2016 that they're going to create this fund, which is already the largest ever. They're targeting $100 billion for the total fund size. They do the first close in May of 2017. They bring on Mubadala, which is the sovereign wealth fund of the UAE. They bring on Apple. So Apple invests $1 billion into the fund.
Sharp, I think, is another $1 billion investor.
Yep. As is Foxconn and Qualcomm as well.
$3 billion from Qualcomm.
Yeah.
I think Larry Ellison's family office. It's a pretty nutty lineup.
It's totally nutty. And so the first close is done at 93 billion. So they still can raise up to 100, but they have 93 billion that they've closed on. As I mentioned at the top of the show, this is like the largest fund ever raised in any other asset class. Private equity, hedge fund, real estate, what have you, is like $20 billion. So this just blows it out of the water.
And it's worth thinking through too, like seed funds will be, 30 to 100 million. You'll have your sort of early stage funds that can typically or traditionally go up to 200-300 million. You've got these funds that go across stages that, people 3 years ago were talking about how quote unquote crazy it was that you were having these new $1 billion venture capital funds and, your Andreessen Horowitzes and your Sequoias. And then this happens. Even if you look all the way up at huge private equity firms like KKR, they manage $168 billion, but that's across a ton of funds. That's happened over decades and decades and decades of sort of building reputation and risk models and sort of an understanding of what the types of investments they're going to make. I mean, this is so unprecedented by an order of magnitude.
Yeah. And the other really interesting thing, so the term of the fund, so what's in the charter of the fund for how long, what its time horizon is 12 years. 12 years plus a 2-year extension. So up to 14 years for this fund to play out. That's even longer than your typical early stage venture fund. The typical early stage venture fund is 10 years plus a 1-year extension. So not only is this the largest fund ever raised, it explicitly has a longer time horizon than anything else, including, private equity funds are usually 5 years. Hedge funds usually have like a 1-year lockup and then you can remove your capital after that. So it's both the largest and the longest time horizon fund ever raised. And
here's why this gets really interesting. So their goal with the fund is to deploy it they want to make 70 to 100 investments, which puts your average deal size around $1 billion. And so typically, like if we rewind in a world before the Vision Fund, you would have a long-ish lifetime for early stage investing. But if you're doing mezzanine rounds, so buying some equity right before an IPO, hoping to get a 1.5 or a 2x markup, or if you're doing growth equity where you think a business maybe has 2-ish, 3-ish more years before a big exit, an IPO or an acquisition, those will be that sort of bigger check size, but shorter life. They're making $1 billion investments and they don't have to return the capital to their investors for 12 years. Like this is very much changing the dynamic of what do big companies do as they mature and how are they capitalized to do that.
Yep, totally. In the past, historically, there's always been an inverse relationship between size of fund and stage of investing and time horizon. And they just completely turned that on its head.
What if we have a ton of money and we don't have to give it back for a while? How does that sound?
Well, to a lot of people, it sounded pretty great.
All right, listeners, now is a great time to tell you about a longtime friend of the show, Vanta. AI has scrambled the whole security picture. It used to be that you proved that you were secure once a year, an audit or a static PDF, then everyone would nod and you're done. But in an AI-first world, that doesn't hold up anymore.
Yep, your risk surface changes every week now. A vendor turns on an AI feature or someone writes in a new model without telling IT, and your posture is different than it was last week, let alone at your last audit. Vanta's own research found that around 70% of companies have this quote-unquote shadow AI running with no security review at all.
Right. And that's where Vanta comes in. They're the leading agentic trust platform, meaning they've built the thing that closes the gap. And the way that they close that gap is Vanta Agent. Think of it as a GRC engineer, that's governance, risk, and compliance, except that it's software and it doesn't sleep. It finds the issues, drafts the fixes, and cuts the time that you'd spend on vendor assessments in half.
In half! Which is exactly why more than 16,000 companies today run on Vanta. Companies like Ramp, Cursor, and Snowflake all stay audit ready and catch the risks that crop up between audits across every vendor, every AI tool, the whole environment.
And that's the real value. Trust has to be continuous now, which is why Vanta automates your security, your compliance, and the work to earn and prove trust. We're huge fans of Vanta over here, and literally hundreds of acquired listeners have become Vanta customers at their companies over the years. So you can get $1,000 off Vanta at vanta.com/acquired. That's VANTA.com/acquired for $1,000 off, and just tell them that Ben and David sent you.
So we promised you that we would be covering the Fortress acquisition here. And again, apologies for the very, very long preamble to it. We'll get to it now. But I think it was super important to understand the context for all this. What happens in the interim between when they make the press release, essentially, of the commitment from the Saudi Arabia Public Investment Fund, and then when they do the first close, in between that, in February of 2017, SoftBank makes a really curious announcement. They announced that they're going to buy an investment firm called Fortress, which was a publicly traded private equity firm and hedge fund, a so-called alternative asset manager. And they're buying it for $3.3 billion. And everybody was kind of scratching their heads. Like, Fortress was and is a manager of multiple private equity funds, multiple hedge funds, multiple credit funds, debt funds.
They invest in things like mortgage servicing, subprime lending, real estate itself,
Zero
transportation.
technology.
Yeah, not at all a technology investor.
This is about as far away as you could get from technology and venture, in the money management world.
They're kind of a second tier Wall Street asset management firm. They're kind of a middle, $70 billion under management. It's a lot of money, but for the types of groups that they would be sort of competing with, they're not the marquee brand.
No, most of that $70 billion that they have is in fixed income credit funds. So these are, think, corporate debt, municipal debt, government treasuries, that kind of stuff. And when you manage those types of assets, the management fees that you take on that are much, much lower. So, a typical venture or private equity firm will take what's called 2 and 20. So a 2% annual management fee to run the business on the capital that they've committed. So if you have $1 billion committed, you'll take 2% of that annually in fees, and then 20% of the upside of profits that you make from your investing. And Fortress, for their private equity funds, had structures like that. But for the vast majority of their capital, it was much lower.
Makes sense. So that's why, it's possible to have that $70 billion under management, but still get bought for what is a highly marked up $3.3 billion.
Yep. So Fortress, super interesting, it was started in 1998, originally as just a private equity firm by 3 former investment bankers, and then 2 others joined shortly thereafter. And this was in kind of the beginning of the private equity boom. And then Fortress has also the dubious distinction of they were the first large private equity, hedge fund asset manager to go public.
Yeah.
Yep. So in 2007, right before the financial crash, they go public. And then this kicked off a wave of KKR went public after this. Blackstone went public.
Which is a fascinating thing in itself, right? Like you have a firm whose responsibility is to manage other people's money and take a fee and profits off of those investments off the top that themselves are publicly traded as equities, either by retail investor or other funds who are buying shares in them, as a basket of other things.
It's nutty. And basically, it's been kind of decided at this point that any fund that would do something like this is a really bad sign and a bad way to manage these companies. And there was a ton of drama with Fortress and with these other firms that did this, because essentially what they did, they took the quote unquote management company public. So if you're an investment firm, if you're Madrona or Wave or, KKR or whomever, it doesn't matter. They're all structured the same way. There's a management company, and that is what the people who started the firm, that's what they own. And the fees that we were talking about, those 2% annual fees on capital commitments, that's revenue that flows into the management company. And that's how the financials of these firms work. Now, if you take that public or if you sell that company, then the fees that your investors are in theory paying the people who run the firm to run
are
the
actually
firm
getting dividended
are now getting dividended out to public shareholders. Like the alignment is all messed up here.
Not to mention, if you're a shareholder in the management company, but the governance of the actual fund is in any way allows it to make independent decisions, the fund could make decisions in its own best interest that the shareholders of the management company wouldn't actually get those cash flows. Now, I would assume upon going public, they needed to structure it in a way that couldn't happen. But it is interesting that you're taking an entity public that is wholly dependent on the fees from another entity continuing.
Yeah. Well, yes. And what it essentially does when you do this, you've created a situation where the fee streams that are supposed to go to the people running the fund and making investments are now going somewhere else. And this is interesting. This is kind of what SoftBank and the Vision Fund have ultimately end up picking up on. If you go back to Massa's now vision of infrastructure, of cash flow, of guaranteed cash flow payments, like what is more guaranteed than a contractually locked up management fee that is going to happen for 10, maybe in SoftBank Vision's case, even 12 to 14 years. So when SoftBank acquired Fortress, everybody said, what is going on here? SoftBank wants to be a technology investor, but they're acquiring this asset management firm. It doesn't make any sense. Well, flash forward, it takes a little while for the deal to close. There was a lot of regulatory scrutiny. It ends up not closing until the very end of the year in 2017, so just a few months ago. Then what happens, as we mentioned at the top of the show, just last week in March 2018 now, SoftBank announces that they are creating a new division of the company called SoftBank Financial Services. Rajiv Mishra is the CEO. He's going to be running it based out of London. And in this financial services division, they are going to build, create, manage, and acquire multiple funds. So the Vision Fund, the $93 billion Vision Fund is put into this vehicle. All of Fortress's funds that they still have, they divested a few of them, primarily the large fixed income fund that we were talking about that was just trading in debt. The rest of those are getting pulled into this vehicle as well.
Which is about 40 billion, right?
Which is about a little over 40 billion. All told, this new division, SoftBank Financial Services, has almost $140 billion in capital under management, with a goal of doubling that in the next 5 years. And all of that capital is getting management fee streams and then eventually profit streams on the value of the investments when they exit them.
Okay, so what we're here today on Acquired to talk about is SoftBank is most of the way. They've got 70 billion of their 100 billion already raised into the Vision Fund.
No, 93 of the 100. So,
oh, I'm sorry. At the time when they announced the acquisition of Fortress.
Yep.
So they've got 70 billion. There's nothing that looks like technology investing about Fortress. Why are they buying Fortress? What are they doing with that? How does that make sense? And fast forward to today, they're under the same umbrella under Rajiv. They've gotten rid of the sides of the business that don't make sense as much. But why? Why'd they do that?
Well, and I think this is what we see now and why we couldn't do this episode till now. People were asking this question, but now it's clear they want, and Masa wants to become the largest money manager in the world. And they're already pretty close. So like the next largest fund manager is KKR, which has 168 billion under management. KKR has been around for decades. The SoftBank Financial Services, has been around for like a year and a half, and they have 140 with a goal of doubling in the next 5 years. So they are very likely soon to become the largest money manager in the world.
Yeah, there's the quote from, I think this is the New York Times, from Rajiv. Right now, we are close to 140 billion, counting the combined assets. If we perform well, we hope to be 2 times that number in the next 5 years. That's a mark on the wall.
Yeah.
Here's a question I've got, David. In one sense, it's just accounting. It's what pocket does it end up in? But the 25 billion that SoftBank contributed to SoftBank Financial Services, does that draw a management fee, and is there carry on that, or how does that work?
Yeah, I don't know. I suspect though, if they structured it like a typical, what would be a general partner commitment in funds. So what the general partners of funds, the amount that they would invest personally into the fund. I suspect there is no management fee on that, but then they get 100% of the profits. So they don't, instead of getting 20% of the profits, they get 100% of the profits on that capital.
Mm-hmm. And so then there's this sort of interesting question of, what is SoftBank Financial Services? Is it a venture fund or PE fund, or call it a private equity firm that has one very large LP called SoftBank that put in 25, and then another very large LP that put in 45? Or is it corporate venture where they've also taken on a whole bunch of other investment, like the biggest corporate venture of all time that actually is a way bigger business than their core business? It's this weird in-between thing that we've not really seen before.
Yeah. Well, let's move into acquisition category now. So I think, what's going on and with this announcement, to me, this is a new major division of SoftBank that is going to be its own business entity that let's just assume they have 2% management fees on capital under management, and that they have 25 billion of the commitment from SoftBank. So they're not getting fees on that. But so remove that down to 115 billion under management. That is an annual fee stream of $2.2 billion annually of just straight cash flow into SoftBank.
As I was skipping ahead a little bit to where I was going to grade, I was just doing my calculation on if just the 75 billion of the non-SoftBank money in the Vision Fund over the 12 years of the fund, that draws an $18 billion management fee. So if you couldn't do the Vision Fund without buying Fortress, was it worth the 3.3 to generate 18 guaranteed over 12 years? It really gets to that guarantee that you're talking about that was so interesting, and what SoftBank saw in Fortress.
Yeah.
And not to mention, if they can 2x the Vision Fund, that carry is another 15 billion. The carried interest on the profits of that venture fund. And the goal obviously is
you mean the management? Oh, if they return 2x in terms of profits on the Vision Fund, then the carry that they get, 20% of that is another. Well, it's even more than that. If, say, the Vision Fund ends up at $100 billion, if they return $200 billion.
Oh, I was thinking of just the non-SoftBank portion.
Oh, just the non-SoftBank portion. Yeah.
They 2xing a $75 billion fund, $75 billion of profit, of which 15 billion goes to SoftBank Financial Services, just as the carried interest off that profit. Now, I bet you they believe they can do a lot more than 2x, but...
Well, I don't know. Maybe they do, maybe they don't. So this is where I think is sort of, to me, this announcement and then doing all this research, what came out of it, the key to me is that realization that Masa had after the tech bubble burst about the value of stable, predictable cash flows and the management fee. So even if put aside performance of the Vision Fund, they could lose all of the money. And yet still, they're going to make $18 billion in management fees over the next 12 years from that, like 100%, certainty. what can you finance within all the rest of SoftBank with that cash flow?
If that's not rent seeking, I don't know how you define rent seeking. And it's just incredible. It's justifiable in lots of ways, but there is no arguing that is just incredible.
Yeah. So for me, the category, actually, I don't know that anybody would have predicted this when they announced the Vision Fund, a year and a half ago, and then announced this acquisition. But to me, this is a business line. This is a new business line within SoftBank that is a asset management business line that is going to be extremely cash flow positive, regardless of the outcome of any of the investments.
Yep. And in a couple of interviews, they've alluded to the fact that Fortress probably isn't the only one in the next couple of years that they're going to buy.
Yep. They're going to buy more asset management firms that may or may not have anything to do with technology.
I thought when I first cursory understanding of this before I did real research was that they needed to buy Fortress to have the sort of credibility to run and deploy a fund before they could raise the Vision Fund. I don't actually think that's it. I think they want to be in the business that Fortress is in, and they want to be in a lot of other financial services businesses too. Yep.
Now, the question then is, why would, if you know this about the incentives, why would you invest? I think there actually still is a really good argument for why the investors in the Vision Fund would invest, which is that if you think about who those investors are and the amount of capital that they have, whether the Saudi Arabia Sovereign Wealth Fund or Mubadala or Apple, there's really no other way to try and generate returns on that amount of capital without doing something like this. You just can't say they wanted to invest in Sequoia. Sequoia's early stage venture fund it will even take their growth fund together too. That's probably about $2 or $3 billion across the two of them.
They're not going to take Apple as an LP taking half of the fund when they've already got all these other LPs.
Apple has hundreds of billions of dollars in cash.
And Apple you can't even put that money back into your core business. Like they're trying and they can't put that money back into their core business to generate a return on it.
Yep. And the dynamics are totally the same with the sovereign wealth funds. They just have so much money. They need to put it somewhere to try and create a return. So actually what the product that SoftBank and Masa have created is a vehicle for that to happen.
One thing we haven't talked about yet is it's called the Vision Fund. What is the vision? And the vision is to own pieces of all of the companies that may underpin the global shifts brought on by artificial intelligence to transportation, food, work, medicine, and finance. And so if you look at the seemingly scattershot investing that they're doing, what it is owning big pieces of companies where they have actually quite a bit of control and, big governing chunks of the companies in a lot of cases that are...
Yep. Way more than your average venture investor.
Yep. That have tons of data, tons of access to, these companies that generate tons and tons of data that SoftBank believes creates the constellation of what the world looks like in the future that is highly autonomous, data-driven, lots of information moving around in real time across a bunch of different sectors. It's a little loose and it's a little fuzzy, but to the extent that you agree with that vision and you believe that that's where the world's going, Masa's been prescient a few times before and there are worse people to follow.
Well, this is really the third time he's tried to do it. This is by far the biggest swing he's ever taken. But the first time was with the first wave of the internet, with Yahoo and Alibaba. Now, SoftBank invested in 800 companies to get those two. But between those two and then Yahoo Japan...
That's the game, baby. Like, it doesn't matter. They got it.
They made probably... $60 billion from Alibaba alone, then you add in Yahoo and Yahoo Japan, that's probably another 10-ish, I'm guessing. So let's say 70 billion. And then now they're in the middle of doing this with the next wave of mobile, that they did with Vodafone Japan, the carrier, then getting the iPhone, and then buying ARM. And now they're doing it with the next future wave of, well, sort of hard to define, but machine learning, artificial intelligence, stuff. The next wave of stuff. And now they're doing it with this massive fund.
It's a broad vision. It's not a vision like we invest in really great marketplaces. It's a vision like we invest in the future of the way that people do things using technology. I mean, truly, like, does anybody have a divergent vision from what the Vision Fund's vision is? Like, do we think that it's not going to be tons of sensors everywhere generating data that are used to make intelligent decisions and do autonomous things and use a bunch of maps and use a bunch of geo data? Like, it just feels like their vision is sort of like what everyone has looked around and nodded their heads and agreed upon is the vision.
But nobody else has created a vehicle like they have.
That's true. That's true. I'll throw in, I also think it's a people acquisition also. It's, it's a business line, but there's 1,000 people now in SoftBank Financial Services. Many of them came from Fortress. They aren't the big name people. It's not Rajiv that's running the operation, but
although we forgot to mention the most important thing about the Fortress acquisition. Rajiv had worked at Fortress directly before joining SoftBank. So he was only there about 6 months, but from Deutsche Bank, he went to UBS, and then from UBS, he went to Fortress briefly and then joined SoftBank.
Yep. Great point. But it's a huge team of people that are really the infrastructure on how do you raise, deploy, manage, account for, do everything that you need in a big fund.
Compliance, a trading desk for
investor
the liquid
relations,
public securities, all of these things. That SoftBank didn't have anybody, and Fortress is over 1,000 people, most of whom are this back office element doing all this. So category, you would say?
I'm still going business line, but it's a little bit of an infrastructure play also. It's like infrastructure of people.
Yeah. I almost said infrastructure, but that was actually what I was going into the episode or going into the research.
Which is not a category that we have on this show. We're taking our license to just add more categories at will.
Add more categories. But doing the research, I really realized that no, this is a business line that is a new thing within a new product and business line within SoftBank.
All right, listeners. Now is a great time to thank our longtime friend of the show, ServiceNow. If you are running a large enterprise, AI agents are likely spread across every team, and deploying them is no longer the hard part.
Yeah. The hard part is knowing what permissions they have, what employees are using them for, or what decisions AI is making. AI security for an enterprise at scale is not a small concern. Like, the risks are real.
Exactly. And the challenge with AI is governing it, securing it, measuring it, and making sure that it actually delivers value. That is why ServiceNow built the AI Control Tower.
Yep. AI Control Tower gives enterprises a single place to see, manage, govern, and optimize AI across the entire business. And it works with any AI, not just theirs. Every device on your network, every permission across every system, every AI agent visible and secure in one place.
And ServiceNow can do this because they've spent more than 20 years building the operational backbone of the enterprise, the workflows, governance, approvals, security controls, and institutional knowledge that power how work actually gets done across IT, HR, customer service, finance, and security.
ServiceNow already runs more than 100 billion workflows annually and trillions of transactions for more than 85% of the Fortune 500. So when companies need a place to govern AI at enterprise scale, they're building on a platform at the center of how their business already operates.
And in a future that isn't going to be one AI, it's going to be thousands of AI agents working across every function of the company. But the question is, who's managing them all?
So if you're trying to turn AI ambition into real business outcomes and make it work safely, securely, at scale, go check out servicenow.com/acquired and tell them that Ben and David sent you. Okay, what would have happened otherwise?
This is like the weirdest one to do this section on.
I know. Well, okay, but let's take it from the investors in the vision funds standpoint. The Apples, the sovereign wealth funds, they have all this capital. They need to do something with it. They want to chase returns. They want to invest in the future of technology. Without something like SoftBank, how do they do it?
Well, let's just say it would have been harder to park big piles of money and generate the kind of returns that the Vision Fund hopes to return. Where is the trade-off? Like, the question is it zero sum or not? Like, are the SoftBank returns that are going to these new investors, these new LPs in the Vision Fund, being generated at the expense of where cash could have gone otherwise? Or by creating this new financial product, have they actually created new value?
I don't know. I'm not sure it could have happened otherwise. Like, who else would do this?
Yeah.
I mean, maybe a bank, an actual bank, as opposed to a SoftBank. But they wouldn't have the credibility.
Yeah, and I guess what happens otherwise is each of those companies try to deploy, because ultimately what's happening is big companies alongside sovereign wealth funds and SoftBank are putting capital into growth stage startups or late stage startups, or actually what they haven't done yet but said they could do with some of it is take privates, so public companies that they take private. And what could have happened is instead of unifying that all into one fund, which takes its own management fee and carried interest, they could have all done that individually through very large corporate venture. But very large corporate venture isn't really a thing, and companies aren't that good at doing that, and it creates conflict of interest all over the place. And so if you have that arm's length transaction of having a separate fund managing that for you, then you get exposed to upside that corporations tend not to get the exposure to because they're worried about cannibalization.
Well, and you're just limited too. I mean, SoftBank made $60 billion from Alibaba, but that's still, even if they had turned around and used all of that capital to reinvest, that's still only $60 billion. Now, less than 2 years later, they have $140 billion because they've opened it up to others as well, to Apple, to Qualcomm, to Foxconn, to Sharp, to sovereign wealth funds.
I guess I'm trying to make the point of like, what does Apple do with that $1 billion? Yes, they could go invest it in startups, but they tend not to.
Right. Oh, yeah. You're saying they would do it themselves.
Yeah, exactly.
Yeah.
Exactly.
Yeah, but they're not equipped to do it. Apple by itself is a lot of money, but it's less money than Apple plus SoftBank plus Qualcomm plus the sovereign wealth funds.
Right. I guess I don't really care about how much money, because it's the same money whether it's all spread out or put together. But for example, let's see, what's a good example of one of these recent big SoftBank investments?
Well, take the Uber investment. I mean,
sure.
that was $8 billion.
Yeah. How do you line up $8 billion from the types of LPs that the Vision Fund has in order to invest it in Uber and have that unified front in order to do the weird tender thing that they did for the lower price? You basically can't get everybody in a line to do that on their own. Like, that's the argument for centralization.
Well, and could you imagine Apple trying to do that? Then it's like Apple's negotiating with Uber to do this thing and to replace the CEO.
The arm's length is actually value creative in that way.
Yeah.
I'm buying it, or I'm trending toward buying it.
Well, I do think it's a new product, you know? Nobody could do something like that before SoftBank.
Right. It's also value creative in the sense, like, if you believe that partially saved Uber, it's massively value creative that company would continue to thrive when they wouldn't have been able to get their ducks in a row before because they had too many warring shareholders. And there could be future Ubers that require someone like SoftBank to do something similar in order to line everyone up.
Which honestly, the traditional venture community, I mean, you've got folks at the end of the spectrum like Wave that is just a totally different thing. But even the larger investors and the later stage investors, they're not really equipped to do it either, because the amount of capital they're bringing is much less. The stakes they're taking are much smaller. If you're taking a 10% stake in a business, you know, let's take the valuation of Uber. I mean, the firms that were investing in Uber's late stage rounds were taking a 1% or less stake in the business. You can't then drive change with that.
Right. Great point. One other thing that I do want to say that you just reminded me of about the Vision Fund is, even though they're deploying private equity sums of money, or even larger than that, they are acting like venture investors. So whereas a private equity firm would either take a company private and cut headcount, or buy a late stage profitable company and cash flow it, SoftBank is primarily buying cash flow negative companies, or chunks of cash flow negative companies that still have a lot of growth left in them, and investing in that growth, rather than trying to suck all the profits out of it and over leverage it with debt or have it declare bankruptcy later or something like that. So it's the first time we've seen this much money from a private investor be deployed into high growth companies. And the alternative that you would see to that is if this is another form of what wouldn't have happened otherwise, but if the Vision Fund didn't exist, some of these companies would have to go to the public markets in order to continue to get growth capital, which we will hold on to until tech themes.
Indeed, indeed. It's the time horizon of the fund too. It's not only is it the largest fund ever raised, it also has, a very long time horizon. So that's why, it's structurally set up to operate just like you're talking about, Ben, to be more of a venture investor mindset than a private equity. I'm going to come in and within 3 years, squeeze. Yeah.
All right. Well, the first tech theme, stay private longer.
Stay private indefinitely.
So that is the question, right? Are we in this period? So to recap, I want to throw out a couple of pieces of data, and I want to try and make this as digestible as possible in a verbal format. In 2017, there was $84 billion deployed by venture capitalists, which is twice as much as 2013. So it's been steadily increasing since 2009, since after the real estate crisis, and twice as much venture dollars being deployed into companies today, in 2017 as compared to 2013. However, the total exit value of these companies has stayed relatively steady, and the number of deals has actually gone down. So the exits are less companies exiting for more money. And so what does that lead to? There's more private companies than ever that are around today. And the question that everyone's asking is, are we waiting for the IPO explosion where the 70 plus unicorns that exist today, the $1 billion plus valuation companies, are we waiting for them all to IPO? Are we somehow believing that there's going to be M&A that's actually buying that many $1 billion plus companies? Like, are there actually acquirers that have the appetite for that? Or are we entering this new era where with funds like the Vision Fund, is it possible to sustainably stay private? And in the old days, that was either sort of owned by the person who started the business, or it went to private equity and it was really, it stopped growth and it was really about cash flows. Are we going to be able to see the Vision Fund create a new way to be held privately through your growth years all the way until profitability and never go public? And then you get segmentation in something like the Vision Fund where there's some sort of true private equity once the growth has graduated, but they still hold onto it for the cash flows. And then there's other younger high growth companies in there. I don't know. It's kind of an interesting, different future. There's pluses and minuses, but one big minus is the retail investors and the American public or any other public doesn't really get access to the profits of innovation.
Yeah. Well, in many ways, I have to imagine that for the Vision Fund, the model for the Vision Fund is Alibaba. They invested in the year 2000. They invested 20 million. And the company then didn't go public until 2014, so 14 years later. And when they went public, it was at over a $200 billion market cap. So all of that value creation happened privately. Now, if that had been in the Vision Fund and generated 60 billion of value, or perhaps even more because they would have been able to invest far more than 20 million in the beginning and along the way. It's like they're playing the venture game where there's a power law, but they're doing it at this enormous scale.
Mm-hmm.
But the downside is like all the companies that aren't at the top of the power law, I think what you're saying is like, what happens to them?
Right. What happens to the 68th unicorn that is worth like $1.1 billion and doesn't have a likely acquirer? I don't know.
Yeah. Well, maybe the answer is just like you're saying, they operate as a private company in the same way that in the past they would have gone public and would have been a $1 to $2 billion market cap public company indefinitely. They'll just be that privately. But yeah, I don't know.
Well, to keep going on that philosophical piece there for a moment, there's a societal trend of wealth polarization, and a sort of parallel trend is more power and more economics going to corporations over individuals. And if the late stage growth, all of the profits of that are going to shareholders like a Vision Fund instead of shareholders like retail investors, then and all the LPs of the Vision Fund are either sovereign wealth funds or huge corporations, that does further entrench that narrative of more of the profits of innovation, even later stage, going to corporations, even when they actually they're not even in the same line of business. They were just an investor in the pool that continue to capitalize that company later on.
I think there's a yes, but here. Yes, 100%. But SoftBank itself is a public company. So anybody, you and I can go invest in SoftBank right now. And then
why haven't
we're benefiting from this? Which is super interesting when you actually think about this and compare that to how it would work otherwise if this were all, if this were, Sequoia or whomever, which Sequoia supposedly is raising I think $12 billion fund
It's the last I saw.
compete in some sense with SoftBank here. The public has zero access to that, whereas anybody, our parents and grandparents can go buy shares of SoftBank.
So at the end of the day, it's just one more money manager in the middle of a chain of money managers who are all getting a cut.
It's turtles all the way down, Ben.
And it is actually circular too. That's the craziest thing is like, I don't need to paint the whole circle, but like there are ways where you can own something and simultaneously be owned by something all the way around. Okay, so my question for you, David, we've talked a lot about the value creation here. Let's talk for a minute about being value destructive. Is there any way that some of the repercussions of what the Vision Fund creates and the amount of capital that it needs to deploy and the speed at which it needs to deploy it, are there situations where that could be value destructive?
Well, talk to any VC in Silicon Valley and they'll talk your ear off about this.
It feels like they may have an opinion or incentives to have an opinion.
Yes. Well, with that caveat in mind, I mean, I think the scenario in which this is value destructive is, what is, I view as, having been in VC for a while and observed like companies, there's this almost like law of gravity with companies and fundraising where if you raise the money, you will spend the money, no matter what your intentions or...
And let's be clear, like that's not just like I wonder how that happens thing. That is largely driven by IRR. Like if you're an investor and you put money in a company, you want to be able to return the most money as fast as possible to your shareholders. So all of the forces at play on that company from, when you put a bunch of money into a company, you get a board seat, you get influence on the business, is to encourage the deployment of that faster so that they can grow faster so that they can raise more, on and on and on and get a return out of it.
Yep. The problem is when you have so much money flowing into the ecosystem and into direct competitors with one another, primarily then the way that the money gets spent is in customer acquisition. And when you have multiple companies spending money in customer acquisition, all you're doing is driving up the price of customer acquisition.
And giving money to Google and Facebook on their ad platforms by both spending gobs and gobs of money against each other, bidding on the same keywords.
It's shocking to me that Google and Facebook aren't investors in the Vision Fund because they're the biggest beneficiaries. Truly.
It also can train an organization to only know how to spend irrationally on customers, where you will never be able to, when you have to spend rationally, be able to get customers for less than their long-term value, their lifetime value.
I'm thinking back to, our episode on Zappos with Alfred Lin and him talking about the best thing that happened to Zappos was the .com crash, where they then had to learn how to operate leanly and acquire customers through things like the ad units in the shoe trays and in the TSA security lines in airports. But it was that they didn't have the competition spending against them in all these things. So the question is, and the sort of downside scenario that a lot of VCs would paint about what the Vision Fund is doing is it's just gonna create this hyper competition in so many markets, like you've seen play out in ride sharing, where the revenues just keep growing and growing, but everybody's hemorrhaging massive amounts of capital in this kind of war of attrition, whether that's Uber or Lyft or Didi or Grab or any of these companies.
Do you think it drives up valuations?
Well, of course, yeah. I mean, if you're taking this money...
Or do you think it irrationally drives up valuations or unjustifiably drives up valuations?
Depends how big you think any individual market opportunity is.
Yeah.
Well, one more tech theme. I feel like we've now painted all sides here. One more I want to slide in before we move to grading is just this whole story and doing the research. It really and learning about Masa reminded me so much of Jeff Bezos. A theme I just want to call out here is what he's done. If you look at the Vision Fund and this whole asset management business line as a business, what he's done is the same thing that Bezos is doing with Amazon, which is adding more legs to the stool of SoftBank, more great businesses with predictable cash flows that can then come in and then use those cash flows to finance the next businesses that they add. SoftBank just happens to be much more acquisitive in how they add businesses versus Amazon, which builds them in-house. But I think both approaches have the same root, which is just being willing to constantly push the horizons of what your company is and how big it can get.
Mm-hmm. Yeah, there's two models of innovation. There's internal and external for big companies. And SoftBank is doubling hard on the external. Like if I asked you in the last 5 years, what innovative product has SoftBank created? It's market engineering and financial engineering right now in a big way. And you look at Amazon and you'd ask that same question and it's 30 things, and it's 2 or 3 that are multi-billion dollar. It's a very different way to go about kind of the same problem. And they have very different reputational things associated with them. Like if you talk to somebody who has SoftBank on their board, they may tell you, boy, it's really tricky to deal with them. They take tons of control provisions. They take a huge number of voting shares in the company. They're highly opinionated on what we need to do and how we need to do it. I think your mileage may vary and different people may say different things, but if an investor is sort of too controlling and coming into a company, it often has negative reputational things associated with it. Look at the way that Amazon is doing it instead of SoftBank. They have 100% of the economics in the new quote unquote company. They have 100% of the decision making authority. They can force any employee's hand in that new quote unquote company to do whatever they want. And so it's kind of this funny not invented here, us versus them, inside outside dichotomy. David, I love the way that you framed it in comparing it to Amazon, because it really it extends the borders of what is the system and who is the us to companies that you own pieces of, rather than just us as a company.
Yeah, it's interesting. Maybe the ultimate what would have happened otherwise would be if Jeff Bezos had accepted Masa's proposal to create a joint venture Amazon Japan. But
Amazon Bank.
Yeah, that'll be a story for another day. Should we grade it?
Let's grade it. The criteria we're grading on here is how good of a decision was it for SoftBank to buy Fortress? And so to walk through that, you sort of need to have since they're not done yet, a perspective on what SoftBank will be in the future, how big it can be, and how much buying Fortress actually had to do with that. And was it worth laying out the $3.3 billion? I'll make the case that just from is it a good place to park your money perspective, they did actually pay up pretty good for Fortress. Yeah. I mean, it was
about a 40% premium.
Yeah. And typically when you're buying a publicly traded company, we see 20 to 25% premiums. So expensive purchase. But, the question is, if it was essential to creating this new vehicle, this SoftBank Financial Services, that, as we talked about, will generate, $20+ billion over the next 12 years from the Vision Fund and Fortress, just from fees, it feels super justifiable. The question is it, Apple Next justifiable? Is it Instagram justifiable? Like, did buying Fortress give them this 100x upside on that purchase?
Do you want to grade first, or you want me to?
I want you to grade first.
Well, I'm gonna go. To me, I never would have said this before we dug in on the episode. I mean, especially being in the Silicon Valley ecosystem here and everybody poo-pooing SoftBank, which again, there are definitely negative consequences to what's happening here. I think it's brilliant. Like, he created a brand new product, which is a vehicle for these very large pools of capital to credibly invest in growth and in the future. And I don't think anybody else except him could have done it credibly. And I think the Fortress acquisition for $3.3 billion as a means to jumpstart that and to, within a year and a half, become the world's second largest, fund manager, and with a goal to, in another few years, being double that. To me, it's an A. I mean, we will see how it plays out over the next few years, but even already, adding that infrastructure to get them the guaranteed cash flow streams from the management fees across these funds is brilliant. So I think it's an A.
Do you think Apple would have put money in? Do you think Sharp would have put money in if they hadn't bought Fortress?
Well, I think they would probably be justifiably pretty worried. Before they bought Fortress, like the Vision Fund was like a couple people, with no management, no compliance, no trading desk, no nothing.
So the question then to me is like, so let's say that they could paint the right picture and get them to put the money in. If they would have been worse at deploying it because they don't have the scale to deploy it, did Fortress actually give them the ability to deploy that capital, or is it still pretty much, Rajiv and Masa that are doing the main investing?
I think you got to think about it beyond the Vision Fund. Like Fortress gave them the ability to be a money manager. The Vision Fund is the first product in this.
I see.
New business line.
I was thinking about do they have to show returns from the Vision Fund in order to raise Vision Fund 2? No, but will they have to raise Vision Fund 3? Yes. And let's say they're not actually that returns focused, they're more fee focused at this point. What really matters in this context, I think, is would they be able to raise Vision Fund 3 and draw the predictable cash flows from the management fees of that?
Well, what I'm saying is it's not even all about the Vision Fund. With Fortress and now with this new unit, the Vision Fund is just one product of what will be many. They're going to buy other asset management firms.
Mm-hmm. I'm less convinced than you, so I'll go A-, but I think this is a very dangerous company for the next few decades.
Yeah. But, again, I totally agree. On the other hand, it's a publicly traded company. It's not like the global public does not have access to the returns.
Right. Well, listeners, before we jump on to the next part here, thanks for bearing with us over this a very long episode. It's a topic I've long been curious about and heard people talk about, and has been the topic of dinner parties, and you get bits of information here and there. The whole story is really fascinating to follow end to end. And if you're still listening, thanks for coming with us on this journey. And we hope that this sort of provides a nice canonical understanding of what is SoftBank, what is the Vision Fund, why is it all happening, and what's it going to be. It certainly shaped my thinking on it.
Yeah, me too. Thank you as always. Carve Outs?
Carve Outs. So I've got two. The first one is a shout out to friend of the show, Brian McCullough of the Internet History Podcast. So Brian's launched a new podcast with Tech Meme called The Ride Home, where you can get highlights of the news of the day. So if you want to stay current in a bite-sized chunk, it's really fun, and Brian's a great host, and it's a really great way to kind of keep in touch with what's going on and get a little bit of Brian's loose editorial on things, which is always great. And the second one is, David, I think I texted you this. I finally got around to reading E-Boys.
Oh, so great.
It is it's such an awesome book. For those who haven't heard of it, it is about the founding of Benchmark Capital. It was published in 2000. So the whole thing is colored with, it's the 5 years, I think, that Benchmark was around. The really sort of special relationships between the founding partners, bringing on Bill Gurley, the early investments that they made, the incredible story of eBay, the nuttiness of the dot-com bubble. And the author is actually embedded with Benchmark to do all of the writing. He's actually in meetings, like transcribing stuff, and he's sort of a fly on the wall. And so
it's crazy.
You do get to hear these really, everyone, you talk to lots of people, especially now in crypto or back in the bubble days, who will tell you oh, I called it. And you're like, really? Because why didn't you move all your money out then? And you get to hear some of the comments in 98, 99 in Benchmark's office, where one partner will say to another, this doesn't feel right to me for these reasons. And it's amazing to actually have documentation of that. And so the most fascinating part of the book is it's really before everything completely falls apart. And there's just a few sort of early indicators of, this feels weird to me, but I would love to, I kind of want, I want to read part 2. What were all the opinions in 2004? And, how are they reflecting on those conversations? But it's also kind of thrilling. It's really well written. So if you like this podcast, you will love that book.
This book could never be written again.
No.
It's the very fact of it being written and the reaction when it came out, no venture firm would ever do this again. But it's just so great that it happened, and it happened with Benchmark, one of the very best firms. I learned so much reading this book. It's just an incredible resource.
David, I don't know much about it. What was the reaction when it came out?
Well, I think Benchmark was mortified because it paints this window into, and during the go-go days too, when everybody was making so much money.
They did all make an insane amount of money.
And all the dirty laundry gets aired, people's opinions of other people and is this founder the right person? Are we going to fire the, and bringing in the new Meg Whitman as the new CEO.
I will say though, Benchmark comes out pretty good.
Oh yeah, they do.
It's the other firms that I would.
All of this stuff tends to be so private, and that's why this book could never be written again. It's a real true window into what it's like on the inside.
In an industry that has only gotten more private.
Yep. And the names are named.
Yeah. And there are the names. Every name that's in there is the names in venture. So.
Yep. Totally recommend it. Well, mine real quick, just can't, give enough shout outs and thank yous to Nick Feit, other friend of the show and former episode. One of the other books he recommended to me was, he's just got all my Carve Outs covered, was The Three Body Problem. This amazing sci-fi book, written by Chinese author Liu Xixin. I hope I'm pronouncing that right. It's incredible. The Three Body Problem is the first in a trilogy. The trilogy is The Remembrance of Earth's Past. Three Body Problem is great. The second book in the series, The Dark Forest, was actually my favorite. There's what the Dark Forest is this completely mind-blowing concept. It's all set in the future and very sci-fi, but it's very realistic too. And the whole series is sort of about an answer to the Fermi paradox. The Fermi paradox being statistically, it's very unlikely that we are the only life in the universe, that Earth has the only life in the universe. But we haven't received any signals from anyone else. Why not? And this is a potential answer to why not. And it's really cool. So highly recommend it. Thank you, Nick.
Cool. Well, David, I think that's all we've got. Believe it or not, we are out of things to say.
I know. Our episodes just keep getting longer.
Yeah.
We need to get some quick ones in here.
We do. Listeners, there's some exciting stuff coming up in the next few weeks. We've got an IPO with Dropbox. We've got, is it technically an IPO of Spotify? A direct listing?
Yeah, I think it's just a direct listing. There's no offering because they're not creating any new shares to sell.
No. So that'll be a fun one. We'll try and get that out in short order after trading begins with a typical acquired narrative and our quick take on what's going on. I think that's all we've got, though.
Whew, we're out of gas.
We are. I'm hungry.
Thanks for sticking with us. Yeah. We'll talk to you guys soon. All right, listeners. Now is a great time to talk about one of our favorite companies, Statsig.
Yes, long-time acquired partner. There is a reason why the best product teams at companies like OpenAI and Notion, Atlassian, Figma, Rippling, Brex, and more rely on Statsig, whether they are iterating on their core product features or shipping AI-powered experiences at scale.
Yep. In the crazy speed of today's AI world, shipping fast is just table stakes now. It's basically trivial to build and deploy your app constantly. The real advantage is how quickly you learn what changes actually created value for customers and how fast you can use that signal to guide what you ship next. Whether it's a feature tweak, a pricing change, a performance improvement, or an AI update like a model change or prompt adjustment, they're not relying on instinct. They're measuring what actually moved engagement, retention, and ultimately revenue. And as more teams build with AI, that learning loop becomes even more important. Building with LLMs introduces non-determinism into your product experience. The same input doesn't always produce the same output, and behavior can shift in subtle ways in real-world use.
So doing offline evals will give you part of the picture, but you can really only understand the impact once your product is live with real users, and then you can measure how their behavior actually changes. It's very different than the way that you would ship features in a pre-AI world where you knew exactly what the software was going to do in production.
Yeah, exactly.
So this is where Statsig comes in. It brings experimentation, feature flags, and product analytics into one unified system so teams can ship safely, test rigorously, and directly link what they changed to how users actually behaved. The result is a tighter feedback loop and learning that compounds over time, so you don't just ship more, you ship better.
So if you want to make learning your competitive advantage, whether you're building new AI experiences or just evolving your existing core product, go to statsig.com/acquired to get started.
If you aren't subscribed and you want to hear more, you can subscribe from your favorite podcast client. If you're on Breaker, comment on this on Breaker. We love the hearts and even more the comments. Would love an iTunes review or an Apple Podcast review. So if Apple Podcasts is where you are listening to this, or if you have a free moment right now and enjoyed this show, we'd love nothing more than share it with your friends on social media, more privately on iMessage, or a review or a comment on one of those platforms. And thank you so much.